Before we get into the actual details of how we're going to take advantage of the 4 or 3 technical trading disciplines in the 4 CPR location setups, I thought I'd just go over a reminder of supply and demand and order flow at and around obvious levels of support and resistance, and even areas of obviously supply and demand. But most traders would be trading support and resistance, especially the 3 trading disciplines. So support and resistance levels are areas on the price chart where there could be a potential change in the supply and demand equilibrium. Traders don't tend to trade outside of levels or in a random location on the price chart. When we are taught to trade, when you got into trading, I got into trading, one of the first things we were taught really to trade was at areas where price is being supported or price is being resisted, and then everything on top of there. For example, if you were trading with candlesticks or you're trading with an indicator, that should be used obviously as confluence, right? But so obviously with breakout traders, retracement traders, and level traders, their foundation is going to be support and resistance, right? So there's going to be a lot of eyes on those levels, and that's where the change in supply and demand equilibrium is most likely to happen. So buy orders are demand and sell orders are supply, and demand can be broken down into 2 categories, or demand and supply can be broken down into 2 categories, which is willing and forced. So you have willing and forced demand, and you have willing and forced supply. Now, willing for demand or willing supply is a trade entry, because traders are willing to commit capital into the market once they see a trade set up. Once everything lines up on a technical price chart, that's where they're willing to put and commit capital into the market, right? Now, forced buying or selling, or forced demand or supply, is when a stop loss order is triggered. They're forced to, exit their trade, depending on whether they bought. So if you press a buy trade on your broker and you get stopped out, that is forced. You are forced to sell at a lower price, right? And the same thing, obviously, vice versa. If you go short and your stop loss is triggered, then you are forced to buy at a worse price. And also a manual exit order, meaning any kind of let's say, for example, take profit. Now, take profit would be a forced exit, and the reason why it's a forced exit is really because you're kind of forced to get out at what you would consider a problematic level. So let's say, for example, we had the market do this and you managed to get in right down here, and there's no level of resistance up until this obvious level here. Now, traders will ride or tend to ride their profit. Some traders obviously will take profits here depending on risk reward, but if you're trying to get the maximum, you're trying to ride the trend, you're gonna hopefully keep a hold of your trade until you reach the first problematic area, which is this level of resistance, right? And this is where you're kind of forced to take profit, because especially if you haven't had any kind of pullback, you're going to be like, okay, well, I'm expecting some sort of reaction to here. If prices do react, etc., and go higher, then fair enough. But you're kind of forced to exit and take profit at any level you would see as problematic, whether traders are consciously aware or subconsciously aware of that. So that would be a manual exit order, and also another manual exit order would be the removal of just getting out of the trade in general. Right, so if you, for example, are buying and prices are going against you, when you exit the trade, that's you manually exiting the trade, right? So either take profit, a stop loss, or when you just feel that, maybe the price isn't going in your direction, maybe it's been stalling for a little bit, traders get bored and they think to themselves, I'm just going to exit the trade and go into something else. So anything where traders are looking to manually exit. That is really forced buying or selling, or forced supply or demand. Now, CPR location trading is centered on obvious support and resistance levels, and usually at market highs or lows around that area, that will induce and seduce willing and forced buy or sell orders, or willing and forced supply or demand.